Please welcome to the stage Abby Danzig, Senior Editor of Bloomberg Live Experiences.
Hello, everyone. I hope you enjoyed your lunch, maybe got a tour of the museum or our office, or had some really great conversations networking. Just a quick reminder before our afternoon program begins that we want you to be engaging with us on social media. So please use the hashtag #SustainableBizSummit. Follow us at Bloomberg Live and at Business. And while you get your phones out, I'd like us to go to a quick poll. I'm trying to wake everybody up after lunchtime. And we're going to go with a little bit of a controversial topic. I think it's been on most of your radars for quite some time, but really ramping up in relevance as of late. Should defense investing be part of ESG? Yes or no? You can vote by scanning that QR code. I think we certainly have seen this become a lot more prevalent in the discourse lately. The Euronext CEO has declared the new ESG to be energy, security, and geopolitics. Curious to see how you all will vote on this piece. If we could maybe scan for our results to see how everybody is thinking about this. Oh, sort of a decent split there. Most of you think no, so we do have a good amount of purists in the room, it seems. But yeah, that's interesting. And I know our next panel is going to touch on this and many more things. So please join me in welcoming to the stage John Flint, CEO of the National Wealth Fund, and Daniel Hanna, Group Head of Sustainable and Transition Finance at Barclays, for a conversation with Bloomberg's Francine Lacqua.
Thank you, Abby. Good afternoon, everyone. I hope you're all hydrated and caffeinated after lunch, because this is what we need. We have a robust panel here to talk about, the business case, but also the case study of transition finance partnerships. So there is also a chance for you to ask questions, so please be very active. You can be as controversial as you want. I know these two gentlemen welcome it, if not more. John, let's just start off. I mean, everybody knows the National Wealth Fund. But actually, for those that haven't kept up to date, like, how would you describe it? What's the remit, and has it been successful so far?
Thank you. Yes, the National Wealth Fund, government-owned policy bank that exists to support and amplify the government's industrial policy and strategy. We were born out of the UK Infrastructure Bank. Some of you might have been aware of that. But in October last year, we transformed from being the Infrastructure Bank to being the National Wealth Fund. So we now have a remit that extends across the full breadth of the government's industrial strategy. We've been given more money. Our notional capacity has gone up from £22 billion to 27.8. We've been given a very big risk budget, £7 billion. And we wake up every day looking for financing problems that will otherwise impair the government's industrial policy and strategy, including, of course, the climate transition.
And so you find them, no doubt. We'll talk about finding the problems, but Daniel, how do you work together actually at Barclays with the National Wealth Fund?
Incredibly closely, and I think it's been a really powerful partnership between the two institutions. I mean, Barclays, we have a focus on supporting the transition in the UK and in the other markets that we operate in. We finance now 162 billion in terms of sustainable and transition finance over the last 2 years. But there are many areas where it requires really pragmatic partnerships to unlock decarbonisation, transition, and that's where we've worked very closely together. So, for example, we've got a focus on investing in climate tech in the UK and internationally. We've got a fund of £500 million. And one of the things that we have identified is there's this gap between early stage companies, lots of venture capital, but then they've got this scaling gap where there's not a lot of in on that side with us to really help scale them up, which we've really welcomed. And then if you take something like social housing, Very large part of the UK housing stock. Accounts for, I think, about 10% of UK emissions, just that stock. 15% of fuel poverty concentrated in that area, but it's actually quite a hard area to finance because retrofitting that takes very long tenors. And so thanks very much to the National Wealth Fund providing a guarantee, we've been able to structure alongside a couple of other banks long-term financing. And we closed our first deal with Vivid, and that's going to impact 2,000 householders and 4,000 residents.
So, John, what's more difficult, actually finding the money or finding the projects?
The money's not a problem for us. We're fully resourced from a public sector perspective. I think that there's a market challenge to find the risk appetite. You know, we've got a risk appetite that's different to the market. We're not regulated as Barclays is, but we do need to put risk capital up against the risks we take, and we're taking roughly 4 times the amount of risk that the commercial banking sector's taking. The really nice thing about the Geopura and Zero Avia investments was actually the National Wealth Fund, or public money, came in after Barclays. We were later stage investors. So this is a great example of, you know, one of the kind of UK's national champions deploying balance sheet capital, taking risk early, doing something that then gives us the opportunity to leverage. The social housing thing, we loved that. I mean, this is one of the hardest nuts to crack in the UK's transition to net zero is our leaky, inefficient housing stock. I think too many have just decided cheap money is the answer. It very rarely is. It's more complex than that. But in this particular case, we were able to unlock, you know, working with banks, we were unable to lock quite a lot of capital, which I think will really stimulate the supply chains, accelerate the development of the retrofit supply chains that in turn will service beyond social housing into the able to pay segment, etc. You know, the National Housing Federation estimated that the cost of retrofitting just social housing, £36 billion. Yeah. The state can't do that on its own. We can't do that in grants. So we have to find others to help fund it. So this was a really nice example of us working in partnership. We provide cheap capital and we leverage Barclays' network, its ability to relationship manage the social housing, the providers, the RPs. So a great combination.
Can I pick up on this point though about is it money or is it projects, which is the sort of old chestnut? And as John absolutely said, it's really neither. It is more complicated than that. But it is about resetting expectations and what is the real risk and how do you structure against it. I mean, look, the money's there. I'll give you an example. We supported National Grid raise over $6 billion last year to invest in the grid infrastructure in the UK. Largest ever raise by utility globally. But then if you look at, let's say, the climate tech space where we've spent a lot of time collectively on, you know, you've got a growth area that's growing 10% in the UK, much faster than the UK average. When we survey climate tech founders, 55% are hiring right now, way above, again, the national average, and yet 90% say they have problems accessing money. And so that is a great growth opportunity. The government's just recognised it in the industrial strategy. But actually, the risk appetite from many players in the market isn't there. And one of the things that I think by National Wealth Fund and Barclays working together is we're just showing, well, actually, you can do this smartly. And what that will hopefully do is catalyse others to follow.
But so what kind of returns are you looking at? I mean, if you look at risk return, but also scaling up, what are the metrics that you follow?
Well, so I think in terms of our climate tech fund, the 500 million that we're investing by 2027, that is absolutely looking at a commercial return in the same way another venture fund would look at it. And I think we've seen already. I mean, we've mentioned a couple, but we've invested in 22 different companies. Majority, 80% are in the UK. A lot are going through tremendous growth multiples. And then when you look at on the financing side, there it's just a question of how you structure and what kind of returns you can get. We've talked about, you've got the big projects. We were in Net Zero Teesside last year, one of the biggest ever carbon capture projects, again, a leader from a UK perspective. But then also we did the first securitization for residential solar in the UK, supporting 28,000 homes get access to that. Very different risks, very different risk returns.
How should we look at defence, John?
Well, we're a government policy bank, so for us, defence is in mandate. The strategic steer that came to me from the Chancellor about 2 months ago specifically asked the National Wealth Fund to consider dual-use technologies where they can support our defence sector. So we won't be doing the heavy defence, building battleships and tanks, etc. That's not where we will be focusing, but we have a specific instruction from our shareholder to explore how we can be helpful in developing dual-use technologies where there's a defence application. So for us, as a policy bank with one shareholder, we don't have to think hard about whether or not that's a good idea. We just mobilise around it.
So can you give us an idea of what that looks like? Because is there a specific project or something where it's dual use?
There's quite a lot of activity in the drone space and in space technology generally, as everything we've learned through the Russia-Ukraine war, or recently in the Middle East. Lots of applications for drones, dual-use applications for drone technology, but also the broader space industry, both the technology required to get things up into space, but then the technology.
I mean, we're actually learning some of the lessons around the climate tech and how we're thinking about that with innovation in the wider economy. And I think John's mentioned too, cybersecurity, another really important area. And I think coming back to the link to sustainability, I mean, energy security is such a key area of focus. And in Europe and the UK in particular, that doesn't have the benefit of large fossil fuel reserves, that is decarbonisation. That is the way that we're going to have low cost, more affordable, more predictable prices. And so this whole aspect of security actually plays into, I think, the sustainability agenda.
But do you think some of these, public-private partnerships get delayed because of either, distractions with trade and tariffs and wars, or just the U.S. retrenching?
There's no doubt that geopolitics can make a mess of business plans and can delay things. My lens is a rather narrow UK lens right now, and in some ways, the fact that the US is on a slightly different trajectory for now means that there will be opportunities that the UK will be afforded that it otherwise wouldn't have. So, we're being very proactive about making sure we're taking advantage of the opportunities. International allocators of global capital might be looking more favourably at the UK now on a relative basis than they would have been 12 months ago. We've got government with a large majority commitment to clear industrial strategy. So I think there's a lot for the market to mobilise around. So disruptions and dislocations elsewhere can be beneficial from a UK perspective.
I mean, I would echo that. We had a very big London conference a few weeks ago. We actually brought over a number of climate tech companies from North America, talking to investors here. We've seen an increase of interest in our investor clients re-looking at it. Investors and companies want long-term policy predictability. They want deep pools of capital. And I think one of the things that the industrial strategy hopefully helps signal is that policy continuity in the UK. And the UK really benefits from very powerful deep pools of capital, but actually has probably the greatest concentration of expertise around climate tech, sustainability, and the related areas that I think is a huge opportunity for the country.
John, because we're doing a case study, can you talk to a little bit of the timetable from when you find a project, you access private funds, and actually you kind of deliver on the outcome?
Yeah, well, there's a very broad range of experiences. So the quickest turnaround time for a deal that we did in the natural capital space, which was some bridging finance for an outfit up in Scotland, was about 3 weeks from learning about the opportunity to closing a transaction. At the opposite end of the spectrum is a project that we spent 3 years on, and we thought we were there about 18 months before we eventually closed it, and it just took a very long time. It was a new technology, a first-of-a-kind technology, and a market that was very risk-averse at the time. So we do corporate finance, we do project finance. We can be very agile because we're a small organisation. So 3 weeks to 3 years is the best indication I can give you.
But I think, I've worked with national institutions across the whole world. And I have to say, I think the National Wealth Fund strikes a very commercial and pragmatic approach, and one that really does understand around what unlocks further capital in an additional way. So, we've talked about a number of areas that we've executed on, but I think, John, fair to say that we're also thinking about other areas that are currently areas of potential to unlock transition, either growth, new jobs, but there is some kind of market blockage that a partnership can potentially unlock. And I think it's making sure that John understands what the commercial imperative is, and we understand what John's strategic imperative is.
If I might just build on that. So particularly when it comes to climate change, too often you get people in a room and they're trying to persuade each other that their view or their argument or their priorities are correct. And I've done that. But I think the really nice thing about how we got working together was we got in the room together and we said, well, I presented my priorities. Daniel, on behalf of Barclays, presented what they were interested in, and we found the overlap. And all the stuff that didn't match, we didn't talk about, but we just focused on the overlap, where that Venn diagram intersected. And there's a big list, and there's more than enough for us to work on. And it just, for me, opened up my mind. I'm not trying to, I don't have to sell the climate transition. I'm not trying to persuade people that our view, or even that the industrial strategy is perfect. Find a private sector partner who's got resources and skills that you think you can leverage, and then do that Venn diagram thinking. Where's the overlap, and just go heavy into that.
But I mean, we're here in London Climate Week, and there's going to be a lot of very worthy conversations going on. Ultimately, the biggest difference, I think, for the way that the partnership worked is we both focused on executing a transaction. Mm-hmm. Because I think too often there's a lot of great ambition, and actually what we need is deals. And deals need to get done, and once they're done once, other people will do them twice, 3 times, and that's how you scale real change.
We have a question from the audience. Abby.
Yes, we do.
And please keep on sending questions.
Yes, scan that QR code. What does the evidence tell us about long-term energy prices for renewables? Are we buying energy security or bringing down costs for consumers with our investments?
We only have 5 minutes to answer that. We could go on for 3 hours, but we just don't have that kind of time.
I'll give you maybe the 30-second version. One, if you want new power, and obviously the big focus around now is abundant, low-cost power. It takes 5+ years to put new gas in, just the supply chain impact. Nuclear, 10+ years. If you want new additional power tomorrow, that has to be renewables. It's modular, deployable. We've seen the costs of solar come down 90%. Wind 70%, batteries 90%, costs are still coming down. So I think for me, as I said earlier, the UK and Europe in particular wants low cost, affordable power isolated from international markets. Decarbonisation is going to be key.
I'd agree, and I'd plant one thought in people's minds, and you can disagree with me, but I think if you think about the rational response from kind of democratically elected governments, we are all going to slightly overbuild our renewables capacity. And we're all going to invest in connecting with each other so that we can move electrons between each other. And there's a possibility 20 years from now where electrons are actually very cheap. And that could be an enormous productivity boost for these economies. So I just keep that thought as an experiment in your head.
John, just going back to the deals, is there a lot of capital actually chasing the same deals? Can it get overcrowded?
It can do. And we're very disciplined not to be in the room if that's the case. The worst thing, we need to collaborate with the private sector, and we need to be trusted by the private sector. And it's really important that we're not seen to ever elbow people out of a deal. For us to come in with cheap public money and make it harder for private sector actors to do their job or to get their returns is not our mission. Plus, I work for a government that has real fiscal constraints that are well understood. So we go looking for problems and weaknesses, and we do try and get ahead of them, but we're really disciplined about not crowding out.
And this, I imagine, is something that you're very conscious about as well.
Yes, I mean, it's actually not often you sit on a panel about transition and you get a question about, is there too much capital going after this? Normally it's the other way around. So, but no, I think absolutely, I think we're also very disciplined. I think where Barclays can bring real differentiation is creating new structures, looking at risks in a different way, and scaling different areas, whether that's in climate tech or securitization or others. There's plenty to do that actually has positive impact and is very capital accretive for the bank.
I mean, not every private capital, is created the same. I'd put it that way, John. So what's the ideal partner?
It's a really important point because, last 4 years deploying public money, having spent 30 years as a steward of private capital, and one of my big realizations is just how rigid the private sector pools of capital are. Banks work in a particular way. The insurance sector works in a particular way, often guided by regulation. And what it means is that when you get a challenge like the climate challenge, where you're faced with decommissioning a high carbon, no longer fit for purpose industrial economy in peacetime with a fiscally constrained government, the status quo probably isn't going to get us there because of these rigidities. So anytime an organization is a bit more entrepreneurial, does deploy balance sheet capital, does invest their skills and their thinking into developing new solutions and innovating, I think we've got to embrace that. We've got to applaud those who are doing it. One of the reasons I'm really happy to be on stage with Barclays today is because they've done just that. But the rigidities, they keep us safe, but when you've got to take new risks to solve a really complex problem, they can be a drag.
Daniel, can you give us an idea of where you think the next best investment is actually for sustainable finance?
It's a great question. I mean, I think the areas where we are seeing a lot of interest and momentum is around things like the built environment. I think there's a lot of innovation that's coming through around how you can have sort of drop-in technologies that can reduce the cost of heating homes in these sort of areas. Also thinking about retrofitting, I think that's a big area, again, of technology. These sort of hard-to-abate sectors, these transition finance, I think this is where there's a lot of focus around renewables, and that's got scale already. How we go after these other areas where the high emitters and you want to reduce those emissions, I think is a big area, and we see a lot of really interesting technology coming through.
I mean, things like retrofitting just are so capital intensive at the start.
And I think that's one of the biggest challenges for this whole space is that the capex at the beginning is massive. And so that's partly what puts off a lot of other financiers. And you kind of need to look past that and say, well, there's a big opportunity because if you deliver that retrofitting, you deliver lower costs, lower emissions, more affordability. And that's exactly how that's why structuring becomes really important to that.
John, where do you see the next big thing, money going to? Is there like a project or a space that looks attractive?
There's lots. I mean, I think we've still got the CCUS and hydrogen economies to build in the UK. So business model design there and revenue support mechanisms and grant pots, etc. So the government has got a lot more to do there. Energy storage to support a renewables grid, both long duration and short duration. I think some really interesting opportunities in the long duration space. Decarbonising the housing stock, one of the more difficult challenges. There's an endless list. We're not going to be bored.
We're out of time, but we have one question. I can't not have a last question from the audience.
Let's do it. And it's going to be another one that you could probably talk about for a long time. But how should we navigate the geopolitics of China being the dominant clean technology provider?
Perfect. In 20 seconds.
In 20 seconds, let's do it.
John?
Embrace it. If we're going to get to net zero by 2050, I think we will be looking back, thanking China for a lot of the technology, the scale, the pace that they've developed and deployed at. I don't think we should be afraid of China in this space.
I mean, I build on that just by saying I think countries like the UK and others can look at where our competitive advantages are. And actually, John's rattled off a couple of really interesting areas around carbon capture, long duration storage. And actually, there are still large areas where the UK and Europe can grow that capability. It doesn't need to compete. It can build upon.
Thank you both, Daniel, Hanna, John Flint, for joining us. Thank you.
Thank you.
Thank you.
Please welcome to the stage Irene Heemskerk, head of the Climate Change Center at the European Central Bank. Ikoswehi Yihahen, Secretary General at Insurance Development Forum, and Nicolas Jeanmar, head of Personal and General Insurance at Insurance Europe, for a conversation with Bloomberg's Gautam Niyek.
Hello, good afternoon. My name is Gautam Naik. I write about climate change and ESG for Bloomberg. And we're here to talk about an insurance crisis. It's called the insurance protection gap. And it's the difference between economic losses caused by natural catastrophes and the insurance that's available to cover it. This is a problem that's been around for a long time, but in a world that's buffeted by climate change, it's taken on a new urgency. And I just want to read a few statistics just to give you the lay of the land of how significant the scale of this problem is. So we all know that, natural catastrophe or NatCat losses are rising every year. In 2024, economic losses from disasters was about $318 billion, but almost 60% of that globally was uninsured. And just this morning, a very alarming headline crossed my computer from Bloomberg Intelligence, which said, climate-related GDP losses in the US have reached $6.6 trillion over the past 12 years, a figure that's no longer just an environmental concern, but a significant financial issue. This cost is second only to the Great Financial Crisis of 2007 and exceeds the impact of both the Great Depression and the savings and loan crisis. So as you can see, this is a global challenge, and this insurance protection gap, as it relates to natural catastrophes, is pretty significant in vast parts of the world. So in the US, it's about 40 to 50%. In Europe, it's 75%. And it's much worse in places like India, where it's over 90%, and Mexico and South Africa. So it would appear that governments, insurance companies, regulators, and other players are perhaps failing us, or maybe the problem is just too intractable. And I just wonder if we could start by introducing ourselves on the panel here. Just if you could describe, your role at the institution you work for. Nicola, do you want to start?
Yes, happy to. Thank you very much for the invitation. I'm working for Insurance Europe, which is the European Insurance and Reinsurance Federation. So we represent the insurance sector through the National Associations of Insurers, like DABI in the UK. And there I'm heading the general and personal insurance team. So I'm looking at regulatory developments primarily at EU level that have an impact on the different business lines of insurance companies. And of course, the question of natural catastrophes and the question of the insurance protection gap has been very high on the agenda for the last couple of years.
Okay, I'm Ekoswehi Yahen. I'm the Secretary General of the Insurance Development Forum, which is an industry-led initiative, but with the public sector, specifically the World Bank Group, as well as the UN, and really with a focus on how do we help developing countries to build resilience, really leveraging the capabilities that exist within the industry. And again, our focus really is on emerging developing countries, but it's also a space that I think bridges some of the concerns that we see emerging in developed countries, and really, again, trying to bring both public and private to tackle what I think is quite a deep structural issue, as you've alluded to.
My name is Irene Heemskerk. I work for the European Central Bank, and there I had the Climate Change Center. It's a unit that's been there for 4 years, and our job is really that we take into account at all arms at the European Central Bank on the monetary policy, financial stability, banking supervision. What is the impact of climate change, being it through the transition or being like addressing the physical risks? And making sure that our models are up to date, that we take into account and we really assess it and take action where needed.
Well, thank you, Irene. So just with your permission, I'd like to sort of structure this in two parts. One is to first go around talking about the scale of the problem in each of your expert areas, and then to talk about what possible solutions are out there, what's being implemented, which work and which perhaps don't work. So just to talk about this from a high-level perspective, the ECB has been talking about climate change being a systemic risk for a long time. And I was wondering, just to start us off, if there's any evidence that it is posing to be a systemic risk to a financial structure of Europe. We know that, of course, industries and economies are affected. You have a drought, agriculture is affected, you have floods, residential market is affected. But in terms of a systemic crisis, is there such a thing yet from climate change, or is that still something a bit fuzzy and out in the future?
It's I think, the biggest question out there. If I'm being realistic, I don't see it here, clear and present danger today. But it's something we should really worry about, because when you see all the transmission channels from climate change, there's so many. So if you are a company somewhere in the east of Germany, and you're dependent on your supply chain, and all these kind of transmission trends through the whole economy, I think it's really big. And from the ECB, we've been looking at this from, if we're talking about the physical impact today, it can impact the economy, really the macroeconomy, so really impacting GDP, because if you think about the catastrophes in Germany, just think about those companies, you see that the assets there are being hit, but it's also more the chronic impact, so extreme droughts over a few years' time, you see that agriculture is being affected, or if you think about the canal houses in Amsterdam, they're all built on these wooden beams. Groundwater is lowering because there's less water, so all these beams get rotten. Approximately 64,000 euros per household needs to be invested in that. So these are just like agriculture, we see it on productivity lines, we see it basically infiltrating through all the sizes of the economy. Then there is, of course, the financial stability and the financial risk it's causing. If you're a bank and you're invested heavily in some areas that are exposed to risk, it could, your collateral could be losing value. And with that, it could, of course, they're higher risk on your balance sheet, but it also limits what you can invest in the recovery again. And then finally, I think the previous panel, I heard a lot of fiscal space as well. If you think about government debt, if you think about the floods in Valencia, the Spanish government in the end put in 14 billion. That's about 1% of GDP. They can do it once, maybe twice, but not that often. And if you see now the increase of extreme weather events, like acute, but also the chronic ones, it's really something we have to be worrying about and take action.
Yeah. Now, the reason I asked about systemic risk as to whether there's an imminent problem is because as your role as banking supervisor in Europe, one of your jobs is to make sure that banks sort of align with whatever climate scenario, 1.5 degree, and they're clearly not doing that. Why is that? What's the challenge?
The alignment of banks on the 1.5?
Yeah, they seem to be sort of regressing a bit in their climate commitments.
So this is beyond the physical risk space, but this is on transition risk. What we see there, and thinking about our mandate, we want banks to manage their risk. And we want to make sure that they're investing, like they know their exposure to carbon intensive sectors, and they have a plan to get out of it and manage those risks when needed. This is the opinion we have. Like we're not policymakers that can set trajectories of, okay, banks can no longer invest in fossil fuels.
Right. But do you think they're doing enough, I guess, is the question.
Well, we have quite a supervisory trajectory for banks. So in 2020, we issued supervisory expectations explaining what we expect banks to do to manage both transition risk and physical risk. We upgraded that, and we even set deadlines by the end of last year. By the end of 2024, we want all banks to meet all our supervisory expectations. And in case they're not, we won't shy away from supervisory enforcement actions. And this is what we're doing in some cases. So are they doing it enough? I think a lot of progress has been made by the banks over the past years, but not all of them are at the place where we want them to be. And that's what we're working on now.
Okay, thank you. So Nicola, the insurance companies are in an interesting position on both sides of the balance sheet. Obviously, you make considerable profits if you're an insurance company by insuring oil rigs and LNG terminals and the like, and fossil fuel investments. At the same time, on the other side of the balance sheet, you have to pay out when there are natural disaster claims, and that number is only going up. Let's talk about the first bit. There is a general feeling that insurance companies, although they have exclusions on, not insuring certain type of fossil fuel assets, they continue to, insure a whole lot of others. And under a sort of drill, baby, drill regime and sort of general backsliding on this, it would seem that insurers would be more than willing to keep insuring these assets if there are more of them out there. How is the insurance industry going to tackle this perception, at least?
Well, I mean, the good and important question, of course. I think maybe a caveat in a way as a representative of the sector in general. I'm not in a position to comment on something which is at the end of the day the sole decision of each and every company in the sense of how they invest and what they underwrite, what risks they underwrite. What I would say is that there has been a lot of initiatives being taken at the individual companies level and through alliances, and a lot happened after COP21 in order to decarbonize the portfolio, and that covers indeed the investment side and the liability side of the balance sheet, so not underwriting certain activities, and that has been done usually with the 1.5 trajectory in mind, and companies have decided not to underwrite certain new coal projects, tar sand projects. I mean, that again is very much an individual company decision. In terms of also reducing emissions, there is obviously the firepower that insurance companies have through their investment, and there we have seen also an evolution in terms of investing in renewable energy, in solar panels and wind farms, and that has been quite important in the last couple of years, also with the momentum of the Paris Agreement to an extent probably. I think the question really is how we transition, how we decarbonize our economies and our societies, how we can accompany that process through the activities of insurance, how can insurance companies accompany that process through their investment and underwriting. So that's really the big question, but I don't think that it is realistic to expect things to happen single-handedly through the insurance sector. I believe there is also a societal responsibility. If companies were all together to stop insuring certain activities, that would have important societal consequences. So I think we really need to do that together, different business sectors, and with the support of governments in order to accelerate this transition toward net zero.
And in terms of the rising insurance losses from natural catastrophes, in some markets, notably in the US, but also I guess parts of Europe as well, premiums are certainly going up a lot in places like Florida and California. Insurers are fleeing the state because of wildfires or hurricanes or whatever, because they don't want to insure this kind of high-level risk. Is there anything the industry can do to close the protection gap in terms of its own response? Because if you keep leaving markets and if you keep raising premiums, that insurance gap will only increase, won't it?
Yeah. I mean, the situation is certainly different in Europe. You have shown the graph with the protection gap. First thing to say is that the situation is very different between the different countries, between different member states of the EU. So the protection gap varies quite a bit. You have also in certain countries where you have schemes in place and others where it's left to the forces of the market, let's say. But even within those categories, there is a very big difference in terms of penetration of insurers. And indeed, there is a protection gap. There is a chance that the protection gap may increase in the future. I think it's important to keep in mind that there are various factors that lead to a protection gap. One is climate change, which is undoubtedly resulting in an increase in the frequency and severity of a number of nat cat events. But there is also the big question of how we build and where we build. And one of the reasons why there may be properties or certain risks that are difficult to insure at an affordable price is that we see that in every country we keep building in areas which are considered at risk of flood, for instance. So there is really, I think it's important to point to the fact that climate change is one factor, no doubt about that, but there are also a number of other important factors that need to be looked at. Right. At the end of the day, insurance has a huge role to play, but we are also, as insurers, at the end of a chain, and a lot has to happen during the chain in order for certain risks to be insurable. And the question of where we build is a very important one in that context.
Thank you. Well, when it comes to natural catastrophes, emerging markets are in a particularly powerless state because we know that the developing world is responsible for a very small percentage of greenhouse gas emissions, and yet it's facing the brunt of the natural disaster risks. What's the challenge in terms of increasing insurance and making sure that there's a safety net? Because a lot of developing countries obviously are deep in debt. They spend a lot of their free cash flow paying off that debt. They can't really spend money on adaptation or mitigation. What are some of the best, how significant is the problem? I mean, I know we're talking about a very varied group of countries, but just broadly speaking.
I think it's a great question. Maybe to set the context, most emerging developing countries, we're talking about 1 to 2% insurance penetration rates, right? Most developed markets, we're talking much higher figures, maybe 40%, etc. So that gives you a sense, as you've said, of what happens when you do have these catastrophes. You also have, yes, some diversity. You have small islands. They have a single event. It's 200% of damage, loss to GDP, right? So that's a deep hole to climb out of. So for us, when we think about this issue of, climate or natural disasters that countries are faced with, we think that there are a lot of capabilities that exist within the industry that can help to address some of that. First is, how do we better understand these risks and the evolution of these risks, and also express that to policymakers in a way that they can take action? So if we talk about drought, yes, is impact on crops, but it's when crops are devastated, you have to find a way to respond to those people, or the amount of resources that are required to get people back to a basic livelihoods is significantly more. That is a drag on the economy. Money that should be spent on education, health, etc., is being spent on responding to drought events here and there again, and also in a context where you do not have deep insurance markets. So I think that there is a fundamental in terms of how industry understanding of risk can be used to better communicate these risks to policymakers. The second is, frankly, we need innovation in products, right? The challenges that emerging markets face, yes, there are products that exist in the traditional market sense that are relevant, that we need to continue to expand. But we've also seen innovations with use of parametric insurance solutions. We've seen regions begin to pool their risk, for example, in Africa, the Caribbean, the Pacific. And that's really with the objective of how can they create scale in order to be able to access the market in a way that is much more affordable. And then there are other things that I think that we can do, which is some insurers are, I think, waking up to the fact that they need to provide better risk advisory services to their clients. So for example, Zurich Insurance, it's really about maybe some of the capabilities that they leverage, if it's their risk engineering capabilities where they advise their corporates in terms of how to manage risks through the supply chain. The question that we are trying to tackle in the IDF is, how do we leverage that in the context of the public sector? That then takes me to the final point, which is the need for engagement with policymakers, the need for public-private partnerships. If we're talking about data, if we're talking about innovative risk transfer solutions, if we're talking about addressing the protection gap, we're going to have to require the industry, policymakers, and importantly, regulators to be around the table. So I would say that for us, it's a complex problem. The industry is waking up to it, but it's also how do you align incentives between public and private and ultimately get to implementation?
That's a nice segue into the second half of what I want to discuss, which is possible solutions, what might work, what doesn't work. If I could start with you, please. So you mentioned parametric insurance. There are, of course, catastrophe bonds, which the World Bank sponsors for developing countries. And there are these very interesting risk pools. Do you think that if these particular specialized and fairly innovative tools were expanded significantly, if it were possible, that would really absorb a lot of the losses of insurance that the developing world is seeing?
Yes.
Okay.
And I say that because the tools exist. Yes, there is scope for refinement of these tools. If we're talking about parametric insurance, the leveraging of data to help us to understand these risks better, but also to reach people. And I can give you an example. Right now, when you look at data from 2023, the global humanitarian financing response was $64 billion US, right? Of that money, only 1.3% was prearranged. So that means that that's money that's sort of ad hoc, found to respond to disasters. But we could actually leverage that in a much more significant way if we say, what about an ambition to move 1.3 to a much larger figure? Right. Working with the industry, helping governments to think about how are you developing disaster risk financing solutions, putting money aside. And importantly, some of the trade-offs, frankly, and you made a very important point earlier, which is a lot of emerging developing country governments are dealing with incredible debt. There's a lot more pressure on every dollar spent. And so there is also an opening within that community to say, how do we better leverage every dollar that we spend, right? And so I think that this is a space where the industry can offer a lot of solutions. And the solutions are not only simply in, okay, responding to disasters, responding to shocks. It's also the fact that in the absence of insurance, it also limits the ability of what can happen in terms of growth. You can't grow if you're not managing your risk. You can't grow if you don't have access to insurance that will unlock access to capital. So for me, I tend to take maybe not a naively optimistic view, but an optimistic view towards we can do something about this.
Okay. What about the insurance industry, Nicola? What are there any silver bullets or any innovative answers to this protection gap, especially in Europe? Let's talk about.
No, I think there is no silver bullet, and it's a little bit the opposite. A lot has to happen in a lot of areas. So if you look at what is, in the end, the protection gap, the risk is related to three main parameters. It's the well-known, it's hazard, exposure, and vulnerability. Hazard is climate change. We need to keep the efforts on reducing emissions. That is a no-brainer. The exposure, as far as properties are concerned, is really about where to build, and there is really something to be done about new buildings. I mentioned it before, and the vulnerability is about how we reduce the exposure, how we reduce the impact of events that are happening. And there is really where a lot has to happen. You need to look at it in a way, region by region, peril by peril, and need to look at what can be done. There is a lot to be done around awareness raising, a lot about having the right risk culture, the right attitude, and these sort of things. So it's difficult to answer in terms of silver bullet, but there is really a lot to do. Adaptation has to happen at the local level, and that is the reality that we need to accept. And then there is, of course, one of the questions that we are discussing with the ECB and EIOPA is whether mechanisms like reinsurance mechanism, pools, etc., also have a role to play. At the end of the day, just mentioning that this can be the case, but the fundamental question of the protection gap is really around reducing vulnerability and increasing insurability.
Yeah, thank you. Actually, perfect segue into the ECB. So in December, you announced this interesting two-pronged proposal to create a voluntary pool, as Nicola just described, and also a mandatory sort of disaster pool where countries would contribute. So if there's a big event somewhere, that money could be used to rebuild. Could you tell us specifically how long it might be, whether this is implemented or not, and how long it would possibly take, and whether this is realistic? Because I don't really understand the full EU process of how this something that starts with an interesting proposal like this becomes fact.
So first of all, I just want to emphasize like the impact I just shared, like on the economic side and on the government space and also the risk for banks. We really find that insurance can be an important buffer to all of that. And that's why we've done this work with EIOPA. We are now looking indeed, we did this proposal, how can we fill the insurance protection gap? And it's this private-public, so it can't be funded only by public money, so private-public, so more insurance, reinsurance, and some kind of public backing for the risk. And on the more national side, having a pooling with the governments of all the EU states putting money into that. How long that will take, this is of course up to policymakers and up to governments to make an agreement on this. Could take a while, but I do see that the European Commission has adaptation and resilience building very high on the agenda. So they're seriously looking into this, and I'm glad that we have showed and gave a suggestion what can be done. But I just want to emphasize, and I think this talks to what has been said before, this doesn't come for free, right? It also requires that countries take resilience building seriously, and depends on like the actions you take to limit the risk, also the contribution you have to make to this fund. So to not let it come for free. So I think that's a really important point.
Do you think 2, 3 years, 5 years? Care to put a number on it? No?
No, I wish I could, but I think politics are hard to... But maybe my last point, like everybody in the room, like, do you know which physical risk are you exposed to? Are you taking in your company, in your home, everywhere you go? Do you take it into account? Are you taking like building resilience measures? Do you know how insured you are? I think this is a topic that it's going to be much more crucial that we tackle that soon.
Thank you very much. Appreciate all of your contribution and your expertise here. Thanks very much. Appreciate it.
Thank you.
Please welcome to the stage David Hostert, Chief Economist at Bloomberg NEF.
Thank you very much. Welcome. My name is David Hostert. I'm the Chief Economist at Bloomberg NEF. We're a research business within Bloomberg looking at the transition to a cleaner economy. And before I walk into this presentation, just a bit of background where we're coming from this time. When I joined the energy sector 15 years ago, the things that we're talking about today were very much kind of the new thing, the new kids on the block. And that means that we feel that the pendulum currently is kind of swinging back a little bit. So we came in kind of the 2010s with this kind of new enthusiasm. Then in 2020, all of this got supercharged, and now it feels like we're slightly swinging back. At a time when the previous panel highlighted some of the real impacts of climate change are actually more real than ever. But when you follow the news, you get the impression that things are actually moving backwards. Hopefully, I can convince you a little bit that we are actually moving forward and that things are happening. Just quickly on our product, so the New Energy Outlook is Bloomberg's set of energy and climate scenarios. This is the work of about 70 experts at BNEF, and we do bottom-up modeling to model the impacts on the energy sector from power to transport, buildings, and industry. This year, we updated our base case, and I'm going to show you a little bit more on what those results are. And we also looked much more closely at the next 10 years. So when you do these 2050 outlooks, people only care about 3 time zones. They care about the next 5 years, that's your average CEO tenure. They care about the next 10 years, that's maybe the board. And then 2050 is some point in the future. But lots of things are happening in between that. And we wanted to look especially at the next 10 years. The New Energy Outlook mirrors the setup of BNEF as a business. So each of these bubbles is a team at BNEF, ranging from the clean power side to transport, industry and buildings, most recently agriculture, also the commodities. And my role as the chief economist when we do these scenarios is to get everybody together and then hopefully leave them equally unhappy. And then I will have done my job well. We have 2 scenarios. So the economic transition scenario is our base case. This is a scenario that's consistent with 2.6-degree temperature warning. And we are taking an economics-led approach. So this is a techno-economic view of the world where we look at the current policy. We look at the policy that is firm and legislated. But then we make no further assumptions about policy, and we look at technology cost. What are the least cost solutions for us to meet demand, how we move around, how we fly, how we consume energy, and then leveraging BNEF's proprietary data on cost pathways and our modeling capabilities, and kind of a bottom-up view of the system. We also have a net zero scenario, which is consistent with 1.75 degree. We didn't build a 1.5 degree scenario because we couldn't. And I can tell you now that our next scenario that we're going to publish next year is probably not going to be 1.75, but slightly higher. This is not to say that there's no solution for 1.5, but certainly when we look at the technologies that we have today and kind of don't introduce magical thinking, these are the pathways that we think are credible. And in order to go faster, we would need to see additional technologies come forward. And just finally, before I go to conclusions, when we talk about the energy transition, it's important that we think about countries, because countries are the agents in the transition. So global numbers are interesting, and they often look smooth, but really it's countries where the transition happens. So we cover 12 key countries, for which we also have country-level reports and data across both scenarios, and then 7 additional regions. The first kind of thought I wanted to leave you with is that actually we think energy emissions are beginning their descent. This chart shows you where emissions have historically come from oil, gas, and coal combustion. And we think that in our base case economic transition scenario, they are at the turning point right now, and we see them down 22% by 2050. This is not enough compared to what the net zero transition needs to be like, and you can see this in the dashed line here. But certainly it's better than the top line here, which is our no transition scenario. This is a world where we just continue to consume as we do, but we don't change anything. So if you think about this kind of road to hell up there, then the difference are the colors in between, and these are the things we did to get to the economic transition scenario. So 75% of emissions reductions in our economic transition scenario are based from clean power. Another 9% is based on, 15% is based on electrification. This is electrification of road transport, of industry, of building. And then there's about 7% from energy efficiency. So clean power really is the major driver in our base case. And in order for us to get to net zero, we would need to activate many more drivers on the right. This means that countries are actually in a very different trajectory. And the groups that countries fall in doesn't neatly follow any more kind of old groupings of OECD, non-OECD. We have about 3 categories. There are markets where emissions are still rising and rising fast, and this includes markets in South and Southeast Asia, India, Southeast Asia. There are markets where emissions are flatlining, and that includes MENA, rest of the world, some LATAM countries, and then really emissions are really falling in the Western economies, including China. There's such a huge China story that we can't delve into, but it is really one of the most interesting countries to look at. The second, also the kind of another finding that's important is that actually, despite the news, despite the headwinds that we've seen, and some of them are very real, we have upgraded our technology outlook year on year. The solid line here shows you what our base case view is currently for these key technologies, and the dotted line is what we said last year. So you can see that wind power in the yellow line is up 20% year on year for the next 10 years. So this is kind of a huge upgrade. For solar capacity. For wind capacity, we held a forecast that's slightly up. There are important country differences, but we're really looking at global trends here. Battery storage capacity up by 1/3 globally, so a huge upswing. And then for electric vehicles, our forecast is slightly down. We did actually publish just last week our updated electric vehicle outlook. It is again slightly down, but don't be mistaken, this sector is still in the steep part of the S-curve. For our sustainable aviation fuels update, there's been a pretty significant uptake as well, and this is based on real project, real data. And the same is true for kind of nuclear, which is kind of more or less stable. And then hydrogen moved slightly to the right. We were never that bullish to start with on hydrogen, so we haven't downgraded as much, but it kind of moves slightly to the right. And then finally, for carbon capture and storage, we've taken a 50% haircut. And this is because we now look very deeply at the project pipeline and looking at which projects we think are feasible, and then a few of them drop out. All this has implications for commodities. In our outlook, coal demand is in structural decline, as is oil demand, and gas is the swing factor. So coal demand is down by quite a bit, driven by drops in the power sector. We see oil demand cresting around 2029, 2030, and then falling, and this is really driven by demand destruction from road. You can see that oil demand still rises in chemicals. There's kind of other dynamics here, but the big swing factor is road transport. And then for gas, it can really go either way. If we're entering this net zero scenario, then gas demand goes down. And then if we go in our base state, we still see this glide path for gas based on very cheap costs in the US as well. So the big factors are here, US demand, it's in the power sector, and some in the chemicals. The biggest request we got this year to add was data centers, so I thought I should leave you with some of our analysis on this. Data centers were held around as this major driver of electricity demand, but really they're just one of several factors. And whatever you think is true about the world, whether this net zero scenario or the base case or whatever, electrification is one of the big drivers, and electricity demand is growing. So we think electricity demand is up by 1/3 in the next 10 years. And then another 75% in the next 25 years. So huge drivers. And this isn't just one single source. You can see that actually electric vehicles are still the biggest driver of additional demand globally. There's some very interesting regional differences because, as you can imagine, data centers are clustered, right? So they really affect individual grids. If you look at PJM, if you look at Malaysia, there's some very distinct points. But overall, electric vehicles are really the main driver. But other things that you shouldn't underestimate are improvements in buildings, air conditioning, electrification. These are big drivers. So overall, EV demand in the power system goes from about 1% today to 11% by 2050. And data center demand goes from about 1.4% today on average to 4.5% by 2050. But look at the spread, right? There's a huge spread. And this is a challenge for decarbonization, because what we find is that as data center demand kind of grows, initially in Europe and the US, but increasingly in Asia, Southeast Asia, and our hypothesis is really that data centers ultimately will have to get built where consumers are. you and I are going to kind of whip out our phone. We want to question AI, and we can't deal with latency. So latency means data centers long-term have to be where people are, and that means the power needs to come from these centers. So when we model this and we input data center demand where we think it's going to be in the 55 energy models that we have globally, then we find that data center demand is really dirty. And this ignores some of the announcement that data centers have made about the procuring they're doing, but it also shows the reality that if a data center with deep pockets kind of buys power, somebody else will not be able to buy that power. So unless these commitments are truly additional, the impact is going to be dirty. And we find that it triggers new gas builds, and we heard about delays in gas pipelines, in gas procurement. There's kind of a huge pileup. The cost for gas engines have really increased in the last 6 months only. But it means that new gas engines get built, and that existing coal capacity that would otherwise have shut down is not shutting down. So we're delaying coal closures, and the renewables in the next 10 years will contribute significantly. But all the things being equal, unless you make it that way, data center demand is going to be dirty. Those were all the findings I wanted to leave you with. If you're a Bloomberg client, then there's a whole lot of other data behind this. We have 12 country reports, 18 spin-out reports, and all the input and output data in annual granularity for these countries. And we have our public website as well, where you can download an executive summary. Thank you so much, and I hope you have a brilliant rest of your day.
Please welcome to the stage Claudine Blamey, Chief Sustainability Officer at Aviva, and Charlotte Wolf-Bai, Vice President and Group Chief Sustainability Officer at Petronas, for a conversation with Bloomberg's Yinka Ibukun.
Good afternoon. In this session, we're going to explore how the Chief Sustainability Officer role is evolving, and we're going to dig into some specific challenges and innovations through this discussion with two very interesting speakers. Claudine is a Sustainability Officer at Aviva, one of UK's biggest insurers, and Charlotte has the same role on the other side of the world, in a very different industry, at Petronas, which is Malaysia's state-owned oil and gas company. So you've both had quite expansive careers in sustainability, but come from very different backgrounds. Claudine, you are actually an environmental scientist to begin with. And Charlotte, I just learned that your background is actually in business and economics. Those are very different backgrounds just to even start the conversation, but we're going to try and basically figure out, maybe with you, Charlotte, how you came into sustainability and how that compares with what could be seen as a traditional path to a CSO role, if there is one.
Well, thank you for that question. So in my mind, I have the strong belief that business has this tremendous potential to be a positive force in society. But capitalism, unchecked in the pursuit of profit, can have the opposite effect. So this is where the role of the sustainability professional comes in. So I've had this tremendous opportunity to work internationally in a number of sectors, anything from pop music, metal and mining, all the way to energy, but always in sustainability roles. So this is my calling from an early days, I would say, already in school. And what sort of is required in a role like that, and I really feel that you have to be curious and interested in so many different areas, because you are a strategic risk manager, you are an opportunity creator, you have to understand complexity, You have to be agile, but also creative, and be able to form the problems that you're trying to solve and really conceptualize what's happening in society inside your business. So it's a bit different from perhaps other trades where you focus very deeply. In sustainability, you have to consume everything, be a bit of a smorgasbord. My Nordic background comes out there, which means that you eat any food at all that's thrown at you. So I think that's the difference perhaps between a sustainability officer and any other trade.
And is there a traditional path to that career?
So when I started, there wasn't, but it was very clear that it was a growing space. I just happened to have the opportunity always to build the function in the company that I have joined. Today, I think it's very different. You can study this at university, and the career path can be clearer. There are now big teams in different businesses, and you can have build a career path within a company working in sustainability. Not so much when I joined, but I would also say that the titles have changed over the years, and who knows what our titles will be in 10 years' time.
That's exactly what we're hoping to get into today. So we've been hearing since morning that corporate sustainability is at an inflection point, and many companies are adapting. One way they're doing that is with changes with their people and their workforce. Since we have sustainability professionals in the room, I would like to take a poll. And so the question is, has your team structure changed in the last 6 months? And so to answer the question, please scan the QR code behind me and vote yes or no. And while you do that, I will move to Claudine, and then we'll come back for your results. So Claudine, specifically actually following up on what Charlotte said, how do you see CSO roles evolving in the future?
That's a good question. I'll get my crystal ball out and look at it. I think it's a tricky question because it's evolved so much, as Charlotte described. I think we're getting more. We went through a period where we were pushing rock uphill, right? And you and I know that really well, where it was really trying to make the whole organisation understand what this means. And then we went, I think, through a period of where everyone really got it. And all they wanted to do to be really good at it and to lead. And so we ended up with a whole load of ambitions, like Aviva's got one, net zero by 2040, lots of other organisations, net zero by this, that and the other. And I think that period then, again, our roles shifted. But I think now it's where the rubber hits the road, and we're actually seeing organisations needing to take action off the back of those pledges that they put out to actually make things happen on the ground. We are shifting a whole energy system from one shift to a whole other energy system. And that means that our roles become about how do we make that transition happen? How do we make that transition happen as change agents in those companies? And therefore, I see our role as partly kind of shifting to strategy. Not that it hasn't been there, it's always been there, but even more so. But then also about identifying risks and, more importantly, helping innovate and understand opportunities for the business, because there are winners and losers when there's a transition. Mm-hmm. And if you're a CSO in a business, you want your business to succeed. Often, especially in my sector, in the finance sector, it's quite difficult to get innovation going. And so I see my role really shifting into that space, into that more innovative space.
Thank you. So we'll check in a minute if the results are out to see what people are saying in the room. And they are out. The results are showing that it looks like just a bit over half the people here have already seen changes in their organizational structures. 55% said yes to the question and 45% said no. So that's quite interesting and reflective. It's still early days, but still reflective of the changes that we're seeing. Shifting to another gear, a big part of your role is also about building consensus. You said about telling people, you phrased it differently, but basically building consensus. And you mentioned Aviva's ambitions. Petronas also has made some ambitions public, namely committing to net zero emissions by 2050. I'm especially interested in Petronas just because it's a hard-to-abate industry as an oil and gas company. And so the question to you, Charlotte, is how do you start to build consensus in a hard-to-abate industry like oil and gas, specifically working for a state-owned oil company which is reliant, where the government's revenues are very reliant on oil receipts?
So in a way, it's quite clear. Your direction is very clear because most governments most countries in the world have signed up to the Paris Agreement and have their own national determined contributions, so the national action plans and targets. So as a state-owned enterprise, obviously that is our North Star. And we are indeed a hard-to-abate sector, so we must also support then that effort. So Malaysia has also reconfirmed its commitment to net zero carbon emissions by 2050, and Petronas has the same. Now, how do you bring the ecosystem with you? That's very, very important. A national oil company shoulders broader responsibilities than a pure commercial player. So you have to generate revenue for the government, but it's also to ensure energy security and building an industrial base. So how do you make sure that whilst you're balancing all those aspects, also with sustainability and addressing climate change, how do you bring everybody with you? And one example of that, for instance, in Malaysia, so we have several thousand vendors in the oil and gas services and equipment sector. So we have developed a program for them, which calls the Petronas Supplier Support Program, where we offer training as well as a disclosure platform, which is matched with financing. And this is to promote more greater awareness, but also practice around emissions management, but also human rights and nature actions. And this is to ensure that the industry is fit for the future. We are not an island as a company, so we have to bring everybody with us.
Thank you. And just briefly, Claudine, maybe to give your perspective from a very different industry and a very different context as well.
Yeah, sure. So the finance sector, and I guess a lot of our organisations are just a part of a system, aren't we? And we've got kind of one cog in the system. And unless you do build consensus from a regulatory perspective, from other partners, other sectors, you won't be able to tackle that system. So one good example is around nature, actually, that we've done recently. We donated 38 million to the wildlife trusts in the UK to restore temperate rainforests across the west side of the UK, because we only have 1% of our temperate rainforests left. Why did we do that as a business? I mean, it's a nice thing to do, but actually, insurance sector is very reliant on resilience and adaptation. And unless we do something like this to help mitigate things like flood risks, we won't learn, we won't know how to do that. So this is a really good attempt at that, but obviously it has lots of other benefits too. There's more biodiversity, they're healthy spaces people can go and visit, people can get involved in. So lots and lots of different benefits come with these kinds of examples as well.
Great. And I mean, would you call that one form of innovation? Is that a new thing that's happening in terms of?
It is, yes. So the pledge was done a couple of years ago. Wildlife Trusts have already bought bits of land across the UK and are rewilding. But off the back of that, the innovation is that we're bringing together a coalition from different sectors to make UK the most resilient economy in the world, looking at nature-based solutions and climate adaptation risks, so particularly flood risk. And then how do we create a financial model that can be replicable in other places in the world that are really going to make this work, because that's what's missing.
So for now, that initiative is actually a donation that you made to the Wildlife Trust. So how do you go from that to making it a financial?
That's what we're going to figure out with the coalition. Yes.
Okay. How about you, Charlotte? Is there any innovation that you're seeing help accelerate the transition of your business or your industry?
So we are a hard-to-abate sector. In the energy sector, it's very important there's a lot of investment in technology, but also business models and partnership models. We have to partner widely across sectors to move forward, because it's a whole systems change that we need in how both energy is produced, but also how it's consumed. So in Petronas' case, we are firmly also committed to build what we call new business, and we have a number of different new value chains that we're working to develop with a number of partners. So this includes carbon capture and storage, renewables, hydrogen, electric fleet charging. We have biofuels, specialty chemicals. And for all of these new value chains, you have to work both on the supply and the demand. So as a good example would be carbon capture and storage, where our shipping arm is now also commissioning new ships for CO2 shipping. But at the same time, you also need to work at the customer end to make sure we can get the CO2 that we can then ship and sequester in Malaysia. So it's a very interesting space right now, because we have to build these new industries that will really create a lot of new opportunities, and a lot of innovation is still required. I would say not all technologies are in place today that we require to meet net zero.
Okay. And I'm just mindful of time, and so as we round up, I'll just ask you to just summarize. We've started with the people changes that we were expecting in your field, but how differently will your companies look in 2050? The title of the panel is The Next Generation. 2050 is exactly a generation away. I may be taking the title too literally, but the question for both of you really briefly is, how differently will they look like from what they look like now? Aviva first.
So I think hopefully still a very successful business in 2050, having achieved net zero by 2040, so already 10 years in. I think that would have innovated in order to adapt to climate change for the customer on the ground, and really made a difference in those customers' lives, in terms of those customers now healthy and happy and are able to get on with their lives.
Nice. And Charlotte?
So I think because we're in 2025 now, we realize that 2050 is not that far away. Last year it felt somehow different. It's kind of almost touchable. But by 2050, we would have reached net zero carbon emissions, and our customers would have also benefited from the clean energy solutions that we would have developed with them, and we would be thriving in harmony with nature, and also achieved a just transition with creating more opportunities and better prospects for more people.
So for Petronas, what would you be producing if not oil and gas in 2050?
So there will be a little bit of oil and gas left, but emissions abated, much more renewables, green hydrogen, and a number of different aspects. I think the energy mix will proliferate a lot across the world, and this is really important, and we are investing a lot in that.
Thank you so much, Charlotte. Thank you, Claudine, and thank you everyone for your attention.
Please welcome to the stage Peter McGuinness, President and CEO of Impossible Foods, for a conversation with Bloomberg's Kriti Gupta.
Hi there. Hello. I'm Kriti. I'm here with Peter, as Francine's voice of God has introduced us. This is a really exciting conversation for me because Peter doesn't know this, but I'm actually a vegetarian, so this is very helpful, and I have been my whole life. So this is
nice.
An extra special conversation. I'd like to think the organizers knew that about me and thought accordingly.
Yeah.
So you were here on a world tour with some government leaders.
Sure.
You're doing a little bit of marketing. You are getting a little bit of the London culture in.
Sure.
So naturally you're came to
and
see
the weather.
me. And the weather, famously.
London in the sun, right? There's no greater city.
You know what? That's true. That is true, though. You just missed the heat wave. That's the best part of the summers here. Talk to us a little bit about how you approach the Impossible Foods brand in this part of the world.
Yeah, I mean, I think, look, we're a US-based company. We're the fastest growing plant-based company in the world. And that's not, a victory lap here because it's not a secret that the category is kind of shrinking, right? It started with a big bang, and there was a lot of publicity around it and several huge high-profile IPOs. And it was the greatest thing since sliced bread, and investors poured money into it. And, it's kind of correcting itself a little bit, and it's kind of contracting a little bit at the same time. And, there's a lot of reasons for that. It's kind of flooded. There's, in the US, you just look at, there's 200 plant-based brands for a $2 billion market. There's just too many. It's confusing to consumers. A lot of them don't taste good. I think it was mismarketed in the beginning. Founders were climate zealots. They marketed as a climate burger. They were against the cattle industry, against farming. It was against and not for, and created bifurcation. It became a partisan issue, became political, became polarizing. I could come up with more P's probably. Oh, processed. Here's another one, segue. And then the meat industry kind of got nervous that we had traction, and they started slandering this industry and calling us processed. And they've called us a lot of things, but that one stuck, right? And you look at the ingredient label, and it's got a long ingredient label because you're mirroring and mimicking animal meat, which is not hard, which is not easy to do, and it's all plant-based ingredients, but it's a long list. And in the UK, under 50% of the grocery stores processed, but almost half, right? And no one really cares. In the US, it's 75% of the entire grocery store processed. But for whatever reason, that's hurt the industry too. And we have not done a good job refuting that. We're a nutrient-dense food. We don't have artificial colors like Red 47. We don't have artificial sweeteners like sucralose. So the MAHA movement, MAGA, whatever movement you're talking, it doesn't really go after us, but that hurt us. So now here we are. We want to launch into the UK, which is a leading market in the entire world for plant-based, right? So the UK is leading, not lagging, in terms of per capita consumption and openness to plant-based options, which is an unbelievable opportunity for everybody, right? And so here we are. This is a beacon of what plant-based could be. The market in the UK now is starting to plateau because consumers are complaining the food doesn't taste as good as it should. And it's a warm beer, cold shower solution. It's a compromise to my animal burger. And so we're trying to put better options in the market to stimulate demand and consumption. And we have the best, of course I'm biased, but it is proven independently, we have the best tasting products. So we're talking to customers and big distributors, and there's a lot of pent-up demand for our products. And consumers as well, and we think us getting here and investing in this market is good for commerce, it's good for the UK economy, it's good for the consumer, and it's good for the planet. And we're kind of just patiently waiting to get regulatory approval, which has been, a bit of a long process. And so here we are.
So here you are. You hit on a couple of things there, and we're going to dive into it. But while we do that, I just want to get a polling question on the screen if we can, because it really touches on some of the points that Peter just made. It'll show up in just a moment, but if you want to get your phones out, scan the QR code. It should be over there. It says, has your organization shifted its consumer messaging away from sustainability? Now, while you guys put in your answers, I want to pose that question to you, because you used a couple of words there, processed, et cetera. Your thoughts on that question?
Yeah, I think we've shifted the emphasis away from sustainability. And I think, kind of marketing 101 is you take yourself out of the equation, right? So personally, I think we should lead with sustainability, but it doesn't work, and it hasn't worked. And there's not enough people, and that's why it's important to have conferences like this. There's not enough people in the world that care about climate right now. And that needs to change, and people need to be educated and more open. And we're an inherently sustainable company, right? So 50 million pounds of impossible plant-based meat versus 50 million pounds of animal meat, saves 4.5 billion gallons of water. I think it's 37 million trees and avoids 1.5 billion pounds of GHG, carbon. So, and there's obviously, I flew over here and I saw this whole thing on BA's sustainability commitment, and they want to be carbon neutral in 20 years. Now, that's not an inherently sustainable company for the environment, but they know they need to do it. So leading with climate didn't work selling food. People thought it was not going to taste good, and then it became political and woke, and that's how the industry was founded. So now we're pivoting, because it is food, and people eat food for taste, and people eat food for nutrition. So ours is delicious and nutritious food, right? It's got 22 grams of protein, 9 amino acids, 0 cholesterol, 0. It's got fiber. There's no fiber found in animal meat, and it's got 50% less saturated fat, so it's nutrient dense. It's anything but processed. And so if it tastes good and it's good for you, that's the broadest way you can appeal to people. Now, if you're interested, we can go third decimal point on animal welfare and water savings and tree savings and GHG and everything there is to know about climate. But it's not the way to lead the marketing of this product, to make it as broad as possible. In the end of the day, chicken, beef, pork, animal is $1.4 trillion addressable market, one of the largest addressable markets in the world. And plant-based is 10 billion. So we're not winning. Plant-based is flat to down. Animal consumption's up 10 to 12%. So we got to figure out how to communicate this in a way. And we insulted meat eaters in the beginning by being anti-cattle and anti-anti, instead of inviting meat eaters. And the last thing I'll say here is, I don't want to displace vegetarian brands. I could, with our taste, we're the best tasting plant-based option out there. I could easily steal more share and get a bigger slice of a shrinking pie against other plant-based. But that's not advancing sustainability in the mission. The only way it works is if people are substituting animal products for plant-based products. That's how you're saving animals, water, trees, and avoiding GHG. So we got to figure out how to appeal. I'm saying flexitarians, which are people that are open to eating meat. They're meat eaters, but they're open to eating plant-based meat, is what I meant to say. There's a whole host of meat eaters that are immovable, and we can't afford to target them right now. But there's a huge swath of the population. Our guesstimate is about a third of the population, which is a massive opportunity, where they're eating meat, but degrees of meat. Some are eating meat with a bunch of plant-based, some are eating meat with a little bit of plant-based. So that's what we need to do, and we need to invite them to try our products, and don't preach to them, don't judge them, don't insult them. So we have work to do.
Well, your approach is in the minority, according to this poll, talking about...
I'm at a sustainability conference. I should hope so.
Well, that's fair. So the poll came in about 65% saying no, they're not shifting it away. About 35% saying yes. I think it's interesting, though, Peter, because a lot of the elements that you talked about in terms of the marketing, making it politicized, making it not really kind of alienating some of the meat eaters, for example, those are American political conversations. What has been your experience in Europe, where there is perhaps a little bit more climate consciousness on both sides of the political spectrum?
Sure, and I don't mean that we're walking away. It's still proud on our packaging. What I meant is the broad marketing efforts, upper funnel, right? What is the communication that resonates to the most people, right? And it's delicious, nutritious food. It's food, right? So it's still on our pack. It's on our website. It's just not in broad-based advertising and things like that. So the reality is the EU and the UK, far ahead of many other cultures and continents in terms of openness to sustainability. And that's why the per capita consumption in the UK is higher. And that's why the per capita consumption in the EU is even higher than the US. So you guys are leading, others are lagging. And, you know, the thing about when you launch a global brand, when we get into the UK, we will adjust our messaging based on the cultural fit. So I wasn't saying that was sacrosanct and immovable. No, I don't want to market impossible in the UK just like we market in the US. It's a different, there's nuances, and I think you have to address that as an adept marketer. But, you know, to the degree that you guys can continue to lead is a great thing, because the world needs to catch up in terms of openness and practice. right? We have two problems in America in a lot of ways, openness and then practice. And you can't practice unless you're open. So.
What does that look like? I mean, openness and practice in Europe. What's the lesson there? What are they doing? What's Europe doing right in terms of that's adoptable by Americans?
Well, look, I think, there's just a general openness to environmental issues versus America, but also to food. I mean, you have half the processed food in the EU and the UK as you do in America, right? Food's made better, right? You refrigerate food. You have more fresh food than frozen, right? So the whole approach to the planet is systemically different than other continents, which is a beautiful thing. And it's been slower to catch on. So, you guys are enlightened. So,
yeah, there's no lean cuisines here. That doesn't exist. But a good reason for that, though, is the way food is regulated here. It's been a real issue.
Without a doubt.
It's been a real issue in terms of things like trade, for example, with the United States and getting even American farming goods into this part of the world. What has been your experience?
I mean, if you go to
that?
France or Italy, they don't allow soda in schools. The government just says no. Now,
I don't know how they live without Dr. Pepper.
But I'm just saying, is that overreaching or is that just common sense, right? So you're starting eating habits in a much better way much earlier. Mm-hmm. And that is, I'm not going to get into debate on government intervention, but that is regulation, right? They're saying that we need healthier foods for our children in schools. And that is coming from the government, which is informing food choice in schools at a very, very young age. Right? That does not happen in the U.S. I mean, there's a lot of bad habits starting very early in life. So, it's not, it's a self-fulfilling prophecy what's happening here, right? And, it's not luck, it's design. And I think that's good. I think if the government is going to intervene or regulate or guide, it should be on very important issues such as health, whether it be personal health or planet health.
What has your regulatory experience been for Impossible Foods specifically?
Here? Mm-hmm. On the slow side, which, by the way, that's a double-edged sword. On one hand, I just sat there and told everyone that when it comes to food and the health of people and the planet, the government should have a keen interest in that. That's one side. The flip side of that is, we've been trying for 4 years to get Impossible in the UK, and we're still not there yet. But we're waiting kind of patiently and patiently to get that done. And there's a path. It's been approved everywhere else. And we're actually ahead in the EU than we are in the UK with the same application, which is kind of interesting. But we'll get there. But it's been slow. And we're ready to invest in this market. We're ready to give consumers better choices. And we're kind of gated because of the regulation. And so regulation's a good thing and a bad thing. At some point, when years and years go by, it's enough.
Have you, just in your travels when it comes to things approaching marketing, but also the regulatory approval, are you seeing a difference between how you approach clients, companies, stores, et cetera, in the UK versus Europe, or is that all kind of one
I think it's all intertwined. I mean, I think, look, we've met with very large customers here, Tesco and Waitrose and Sainsbury, and they all want our product. Because they want to expand their category, right? And they're starting to see trends where the consumption's going down because consumer wants better tasting food. So they would love our products here. And that's both commerce and that's also both, giving consumer choices, which is what they want to do when it comes to food. And also there's been tremendous food inflation in the UK, right? And I think within that, animal beef is driving a ton of inflation. So actually having a plant-based beef product that has equal the protein delivery and zero cholesterol for the same or less cost, I think is a good option for consumers as well at this point. So there's a lot of reasons why this makes sense.
So there was an era not too long ago, I'm not sure how strong this is, but an era not too long ago when inflation in general wasn't as much of a factor into people's thinking. Sure. But one where people were willing to pay up for the healthier option. So if you had an organic offering and a non-organic offering, people would pay a little extra for the organic offering. Are you seeing that behavior maybe change a little bit? Is that affecting your strategy in terms of making a healthy, sustainable option achievable and viable at the end of the day?
Yeah, I mean, we are seeing a change. I mean, you know, to pay a premium for something that's organic or grass-fed when everything else is a premium, something has to give.
Yeah.
So you are seeing, I mean, right now our product is kind of at parity with grass-fed organic beef, which is an amazing accomplishment because the people eating grass-fed organic beef are open to plant-based. But we are a premium to what I would call the private label base well-ground beef in this saran wrap and, you know, the bottom of the thing. We are a premium. And we're trying to drive those costs down because in an ideal world, we would be delicious, nutritious, and accessible and affordable. DNNA, delicious, nutritious, you know, accessible and affordable. So, but we have work to do. Now, part of that is scale, right? And when the market's contracting and we're held up and regulated, it's hard to scale, right? So that will come down with scale. And like I said, if we get the distribution in the UK that we think we're going to get, and it'll be broad-based, I look at this very reciprocally, right? We would not only invest in people and advertising and marketing, but we would probably invest in local manufacturing, which again would drive costs down from a freight perspective and better for the planet perspective because you're shipping and trucking and, you know, less miles. So there are ways to take cost out, but right now, plant-based is a premium, right? So of course, that's going to hurt us disproportionately because everything's a premium, right? And people really feel it. Feeling it in the U.S., but they're really feeling it here. I mean, I've spoken to a lot of people in the last 48 hours where grocery prices are a huge issue in the UK.
I think on both sides of the Atlantic, the sensitivity to prices and inflation and costs is enormous. Talk to us a little bit about how quickly you can scale. When you get the green light from whichever governments you need the green light from, how quickly can you scale up?
We're ready. We have manufacturing already identified in the Netherlands, ready to go to do the initial shipments here in the UK and the EU. And like I said, if it takes on like we think it's going to take on, we'll move the UK production to the UK. We can scale immediately. We're ready. We have all the ingredients. The whole supply chain is ready to go.
So outside of regulation, let's put that on the side for a moment. What keeps you up at night? What are you worried about in this kind of marriage of healthy eating and nutrition and affordability and international market?
It's a great question, and it's not what you think. It's not the naysayers that say the category is dead. It's the opportunity that keeps me up at night. And I laugh at the naysayers and the cynics, right? It's easy to be cynical. Oh, the plant-based category is declining, it's over. It hasn't even started. So when I look at plant-based, it's nascent, it's in the beginning. We need to mold and shape it and grow it. And I just look at the data, it's simple. You're talking below 20% household penetration, really across the board, around the world. It's higher here, but 80%, roughly, of the population hasn't had a plant-based option. Now that's a challenge and a massive opportunity, and that's on us to market it right, distribute it right, make it more accessible, communicate it in a different way. When I look at awareness levels of anything, Beyond Meat, corn, Veg Butcher, Impossible, they're all under 20%. That means 80% of the world population has never even heard of these brands. Now you can change that through advertising, communication. When I look at distribution, I'll just give you a stat in the U.S. as an example. Our sales force has done a nice job. We 1,000 distribution points, 1,200 distribution points in retail grocery, and there's 9,000. So there's so much more distribution to get in terms of making it accessible. If I look at food service, we have under 50,000 distribution points in food service. We're number one in food service in plant-based, but there's 1.4 million locations. So what I say to the cynics is we're in first gear. This category is not dead. It's ready to take off, but it needs good brands, it needs better food, and it needs investment, right? None of the plant-based companies, and I sit on consortiums and plant-based companies, and I've been very vocal about this. You need to invest. I mean, Unilever, Nestle, all these legacy, Coca-Cola, all these legacy CPG companies, there's a playbook. You invest in trial and awareness, and it takes money. Problem is a lot of plant-based companies are stretched. They're small, they haven't scaled. Investment's dried up. It's hard to capital raise right now, right? The IPO markets are tough, so they haven't been able to have a liquidity event. So they have debt, low cash, no investment, right? And so that becomes a self-fulfilling prophecy. We're not out there on our front foot playing offense. We're playing defense. So this is all fixable, and it's just going to take some time. And by the way, the political nonsense and different changes in administrations, they come and go. right? So, that's not forever. And so plant-based will be, the last thing I'll say is plant-based is here to stay. And there's a variety of reasons, whether you are pro-planet welfare, pro-animal welfare, you're pro-personal health. There's not enough meat to feed the world population. It's here to stay. Where it grows fastest, where the innovation comes from, we can debate that till the cows come home, pun intended. But the fact that it's here to stay is undebatable, right? So it's up to us to push it and market it and expand it.
On that note, just make me a promise that the next time you come into this very sustainable, big Bloomberg building, you'll bring us some samples.
Absolutely.
Yeah, great.
I would get arrested at Heathrow if I brought some products that were not approved by the FSA.
Well, hopefully next time you arrive, we'll have crossed that barrier.
But that's a promise.
Done. All right, Peter McGuinness, President and CEO of Impossible Foods, folks. Thanks.
Thank you.
Before we walk off stage, I just want to promote our Business of Food newsletter. We are going really big on the idea of business of food, talking about some of the things that Peter was just talking about, climate trends, consumer solutions, et cetera. You can subscribe to it. You'll find it online. I'm sure you'll find it on every platform Bloomberg has to offer. It's a weekly newsletter on Fridays. That's getting into this idea, climate solutions, marketing, a little bit of trade, some farming. I'm sure agriculture and all of that on both sides of the Atlantic will feature. Maybe even Peter one day. Tune in. Thanks, guys.
Thank you.
Please welcome to the stage Will Kennedy, Senior Executive Editor at Bloomberg, and Natasha White, reporter at Bloomberg, for a conversation with Bloomberg's Sarah Wells.
Thank you, everybody, for being here. I've got the task of grilling my colleagues on the road to COP30 in Berlin, which is a challenging one, and there's a lot to unpack, and we've only got 20 minutes. I've got lots of questions, but I hope you do too, so please send them in, and we will find time to ask them. Maybe, Will, I will start with you. Can you just set the scene for everyone in terms of what we know so far about the outcomes we might see at COP, and also the elephant in the room, or perhaps not in the room, that is the US and the part that they may play in these proceedings?
Yes, I think that's going to be the focus for everyone, is a COP with the US about to leave Paris for the second time, and US that's actively hostile to the idea of global climate diplomacy, that is hugely skeptical of climate change. That's a pretty challenging backdrop for all the other people who are going to be there. I think one question is how the US will behave, because it takes them a year to leave Paris, so they will still be present and able to attend. And I think one question people will want to answer, and we had our colleague John Ainger at the pre-COP conference in Bonn this week, and I think he picked up that people were nervous about how the US might behave and whether they would become a spoiler. I think that's one question for people. As to what can be achieved, I don't think at this stage people are thinking there's a huge goal. If we think about the last couple of COPs, it was in the UAE to get that language about transitioning away from fossil fuels was the sort of headline goal. Last year it was about the finance target. That hasn't emerged yet, but we got some important things on the way. We're waiting to get everyone's nationally determined contributions, which will be very important in terms of setting the level of climate ambition. And I think that for Brazil, it's a very big diplomatic moment for the country, for President Lula, and he will want it to be ambitious. The one thing that I think a lot of people will be focused on is finance again. That was the big thing at Baku last year, but actually making that happen, getting that $300 billion that was pledged, trying to turn it into 1.2 trillion. That will be a big focus, but we can unpack that a little bit more.
Yeah, actually, I might turn to Natasha on that. I guess an integral part of COP, both the formal negotiations and then the sort of private sector sideline discussions are all around that finance picture. And this is the first COP since we've seen a lot of banks pull out of net zero banking alliances, particularly US and Canadian ones, but not only them. So will they still play a part in these proceedings? And what does that sort of broader climate finance picture look like right now?
Yeah, so we're obviously still a few months out, but what we're hearing so far is that at least the largest banks and investors will have a presence in Brazil. I think there's a question as to whether they'll be in Belém itself. There's an event, or there are events in Sao Paulo the week before. I think there'll definitely be presence of the senior executives there, and perhaps some are sending sort of technocrats to Belém, but whether they'll send big delegations there, I think is very much still a question. I think everybody is still a bit concerned about the logistics, where people are going to stay, all of this. So I think they will be there. It is interesting. It's, as you said, it's the first COP since America's largest banks and others have left the NZBA investors as well. So how, and it's been a very hard line to tread this year between US stakeholders and European stakeholders, how you speak to each of those. So it will be interesting to see how that pans out at the event, how they position themselves. On climate finance, it's always a tricky one in terms of the numbers, because the numbers are, they're created with a time lag. So the OECD, which kind of tallies the formal climate finance numbers, did so last year for 2022, found they had hit the 100 billion per year goal for public finance, but 2 years late. We're now, targeting a new goal that was agreed last year in Baku, and we don't have the numbers yet for that. The CPI in the US calculated that there's around, I think, 196 billion for emerging markets created last year in climate finance, but that relates to the $1.3 trillion goal. So that sort of illustratively for 2023 shows we're still a long way off. And I think if you look at what's happened this year, obviously with Trump pulling overseas, all sorts of overseas finance, gutting US aid, and then in Europe, we're seeing development finance budgets being reallocated to defence. Like, it's obviously not painting a very positive picture for how that might be panning out right now.
Although we have done some interesting reporting on allocations to defence finding their way back into climate, right? So perhaps all is not lost. We will come back to the finance piece, but given we've touched on banking, touched on the US, Will, I wanted to ask you about China, because they will be pretty important to what we see happening in Berlin.
Yeah, I mean, China is always a key player at COP for obvious reasons, and they tend to take a leadership role when it comes to the grouping of emerging nations. But I think it's important to remember that one of the most important drivers at COP, especially at Sharm el-Sheikh, at Dubai, was this bilateral relationship between the US and China, between John Kerry and his counterpart. And obviously, that's not going to happen anymore, and China will, in some senses, be on its own. But the relationship that really matters to China in this COP, because it's a very important relationship to China more broadly, is Brazil. It's a very important economic relationship. Brazil is a key supplier of natural resources, especially food, to China. And I think that for that reason, this may be the first COP in many years that Xi Jinping appears at, which will be very important, I think, to the profile of the COP. He will want to be part of a successful COP. And the Chinese delegation will want to ensure that progress is made. So I think watching China, looking at what they want to achieve, their posture will be very important to understanding how the COP develops and its success or failure.
And a slight change of tack, but given this this is a COP in the Amazon, it's being branded as sort of a COP of forests. Natasha, I wanted to ask you specifically on that point. Can you talk a little bit about the action that we may see in terms of support for global forests?
Yeah, so I think the big kind of flagship pitch or proposal that Brazil are bringing into COP30 is this tropical forest finance facility, the TFFF, which is it's been described as an audacious idea. It's interesting in the sense that it's a non-market mechanism for protecting standing forests, which carbon markets have historically failed to do. They prevent deforestation rather than protect the finance those that are already standing. So that's interesting. That it's a $125 billion fund. They're looking to raise $25 billion in kind of cheap funding from government sources and philanthropy. Use that to leverage $100 billion from the markets. Invest that $125 billion into higher yielding emerging market bonds, and use the differential between the cost of borrowing and the higher returns in emerging markets to they're targeting $4 billion a year there, which they've then calculated they can pay each country. There's about 70 countries, tropical forest countries around the world, $4 a hectare to protect their forest. And it doesn't sound like a very big number, but it's a block payment. So if you've got 100 hectares, you'll get $400 per hectare. My math is awful. But it's a block payment, and then there's a big penalty if you fail to comply. So you also get deducted money. So it's interesting whether or not they'll be able to raise $125 billion, which they need to lever the 25 to lever the 100 this year, or even in years to come in the current climate, is a big question. And there's other questions kind of around how that fund's going to operate. But that's their kind of big pitch that they're coming to the event with.
Mm-hmm, mm-hmm. And how does that relate back to the health of the Amazon and Brazil's own problems, I guess?
Yeah, so I think under Lula, Brazil has succeeded in bringing deforestation down. It's home to, I think, 2/3 of the world's tropical forests. So it's a very important country, obviously, in that sense. But this was sort of reversed somewhat last year, which saw globally tropical and boreal forests saw the worst forest loss on record due to wildfires. And Brazil was responsible for 42% of that, so more than any other country. So last year, the COP host saw the worst loss of forest than anyone else. That was due to wildfires, but also cattle ranching and soy. So they have got a lot of work to do, and there's also a controversial bill that's working its way through the channels around loosening environmental permitting. So that's not coming at a good time either in terms of COP and protection of forests.
Mm-hmm. Yes, I think just to add to what Natasha said, that Brazil's economy, environmental record is quite interesting. The previous 3, even 4 COPs, if you include the UK, have had a lot of controversy because they've been in oil-producing countries, especially the UAE. Dubai took a lot of heat internationally for hosting COP as one of the world's biggest oil producers. Brazil produces more oil than the UAE. It pumps 3.5 million barrels of oil a day. And I don't think that people always understand that about Brazil. Obviously, it's a very different, much bigger, broader economy than UAE, less dependent. But I think this shows the complexity of the situation. And to make the point about deforestation and soy that Natasha just made too, Brazil is by far the world's largest soy producer. The amount of farmland planted for soy has increased by 50% in the last 10 years. Now, that's not all in the rainforest, but it's put enormous pressure on the rainforest, and it's also the second biggest cattle producer, again, putting enormous pressure on the rainforest. So I think, in many ways, a lot of people in the climate community will be excited that it's in Brazil, a more liberal country than some other hosts, but we should see the Brazilian posture in the round. And of course, it speaks to the complexity of the energy transition for every country in the world. But I think it's interesting to look at the scope of the Brazilian economy and the challenges it faces.
And I want to pause there and just remind everyone that you are more than welcome to ask questions. We would love to hear from you. But Will, maybe I'll stay with you. As we head towards November, you've talked about a lot of the sort of key news points that we're watching for. But is there anything else that you'd flag or that you want to go into more detail on?
So obviously, this is a year when everyone has to resubmit their nationally determined contributions, as I mentioned. I think there will be some focus on that. Some people have done it. The UK already announced at Baku a more ambitious NDC, and the current government seems quite committed to trying to stick to climate targets. But obviously, it's a world where the political vibe, if we like, around climate change feels quite different to it did, say, at Glasgow or even Dubai. So I think there will be quite a lot of focus on how those NDCs and how countries maintain their ambition. And two that we want to look at, particularly, I think, because they incorporate a huge slice of global emissions, are China and the European Union. I mean, China has said, and I think people were pleased about this, that the new NDC will be a whole economy NDC, so it won't just be carbon, which was progress, but I think they will have to lay down targets for 2035, and there will be a lot of focus on how ambitious those are. And the same goes for the EU, which of course has very ambitious carbon targets. The new Commission, I think, is going to be able to craft a deal that sticks to them. But again, 2035, Europe has to do a 55% reduction in carbon from 1990 levels by 2030. How much faster will it go by 2035? I think a lot of people will be watching that to get a picture of global ambition. And those numbers will go into some work that we've done around COP about where we are in terms of, if we stick to those NDCs, how much global warming do we get? The other country to watch, I think, that's quite important is India, of course, another enormous emitter. And I think there's some worry in the climate diplomacy community that because of the wider environment, because of Trump, because of Modi's economic imperatives, that India isn't really engaging and not showing much ambition. So I think that's something that people will be watching as well.
Mm-hmm, mm-hmm. And some of our colleagues actually had a story today, on to your point around Europe, talking about the European Commission's aim to get a 2040 target out next week, but some pushback that's happening on that. So you're right, it's a very active space. Natasha, you're our sustainable finance expert. What trends are you watching as we head towards November?
I think one big area, again, in Brazil will be nature. Debt for nature swaps, these deals where countries refinance their debts and using concessional finance and allocate any savings towards nature conservation. They have been much hyped in previous years. Last year, the market almost doubled in size in the last couple of quarters alone. With interest from the largest banks, JP Morgan, Bank of America, Standard Chartered, they've all done deals there. So I think that's one area that's interesting this year. It's really kind of tapered off. We've seen no deals during the first half of the year. I think everyone's very much in a holding pattern. These deals do rely on money from multilateral development banks and other kind of sources of concessional finance. And obviously, the US International Development Finance Corporation has been a big supporter with political risk insurance. There's big uncertainty there around whether they would still back these kinds of deals that promote climate and nature objectives. Likewise, some of the MDBs in which the US is the largest shareholder. So I think it's in a holding pattern. I think there's a lot of conversation around changing the use of proceeds, so using the same deal structures, but rather than supporting climate or nature projects, maybe allocating money to broader development objectives, although of course that's not hugely palatable to Trump administration either, or energy security, which obviously may well be more palatable. So that's one area we're watching. I think also developments around the carbon market, the Article 6 carbon market, there's not going to be any formal negotiations there, but there's lots of efforts underway to try to revive the voluntary carbon market. I think Brazil's got a very sort of split stance on that. They've hosted a lot of REDD+ projects in the past. They've benefited hugely from the old UN Clean Development Mechanism. But then they've also come to this event with this big TFFF, which is not, it's really an alternative to the carbon markets for forest protection. So I think those are kind of two areas that we'll be tracking.
And Will, do you have any thoughts on that sort of point that Natasha just raised about multilateralism and what that will mean at this COP? Because it's clearly being tested. I think Ambassador Correa de Lago has made comments to that.
Clearly it is deeply tested, and it's tested in climate, but of course it's tested in all sorts of ways throughout the world, as we see in this completely frenetic news environment that we're living through at the moment. I think it will mean that those countries which tend to take a leadership role at COP will be very keen to ensure that it's a successful COP, that it doesn't end fractiously, that we can get to an agreement. I think it will be difficult. I mentioned India, but we've seen at recent COPs that there are other countries, Saudi Arabia principally, but also Iran and Russia, and we should always remember it requires consensus to get a deal, which haven't prevented deals happening, but which are keen to assert the interests of fossil fuel producers, are keen to make sure that language is moderated around the energy transition and the transition away from fossil fuels. And I don't think we can expect them to back away from that in the current environment. And given the stance of the United States, even though the United States won't be involved. So it will be tough to maintain that multilateral stance, but they will have the support of China. And I think one thing we can say is that Brazil is a country with a lot of diplomatic clout, with a very strong diplomatic tradition, a big diplomatic network, and perhaps Azerbaijan didn't have that. So I think they have advantages and they have a lot of goodwill from people. So fingers crossed.
Well, we've run out of time, but I did want to mention that we'll be covering COP and, of course, the energy transition and many other interesting things in 2 of our daily newsletters. Green, which is available to everybody, and Energy Daily, which is for digital subscribers only. So please check those out on our site and subscribe. And thank you so much for joining us today. I believe our lovely MC has some final remarks, and then I think that I saw some drinks being put out outside, so thank you.
Well, Natasha, Sarah, thank you so much. And I promise I won't keep you guys from those drinks for too much longer. I just wanted to say thanks to my colleagues and all of our speakers and moderators today for a fantastic program. I would also like to thank our presenting sponsor, Schneider Electric, and our participating sponsor, Envision, for making today possible. For more information on our sponsors, you can visit the Resources tab on the Summit website. And Envision just came out with a hot off the presses smart paper on the hydrogen-powered energy transition. You can scan the QR code behind me to download, and that's another one that's going to be coming in your post-event email, so you can keep a lookout for that. And most importantly, thanks to all of you for being such a great audience. We love having you out here. This is the first stop on what we're calling our Summer of Sustainability Tour. We have 2 events coming up in short succession here. The first one is Bloomberg Green, which will be in Seattle, July 14th through 16th. And then the APAC version of this summit, which will be in Singapore on July 30th. And I think that is about it from me today. If you're interested in any of our events, please go to bloomberglive.com/calendar. We'd love to see you or any colleagues there. And let's go celebrate. Cheers to a wonderful summit and a wonderful London Climate Action Week. Thank you.